So today I will talk about housing markets and financial stability. And the focus here of my talk will be to explain why it is that central banks are concerned about housing markets. I should say central banks and financial regulators. In Ireland this is somewhat unusual because the central bank and the financial regulator is one and the same. That's typically not the case in other countries, or frequently not the case in other countries, but it is the case here. So I would like to discuss why it is we are concerned about developments in housing markets, and I hope that therefore that my talk will match up quite well with the rest of the conference. I should tell you from the beginning that there are two speeches, in fact. There is a written formal speech that will be made available afterwards. It will be on the central bank's website. Now, I don't want to read off that speech because that would be extremely dreary. So instead, I will simply give you a PowerPoint presentation that, if you like, picks up the highlights of this speech. So that's going to be a little bit more interactive and a little bit more, I think, a little bit more fun for you. And now I need to figure out how to change slide here to like this. Okay, great. So I think central banks care about housing markets for three reasons. And the first of these reasons is that the housing market plays a very critical role in what's known as the monetary transmission mechanism. And by that I simply mean the way in which monetary policy impacts on the economy. And the way this works is very straightforward. People buy housing by borrowing funds, or if they're going to rent out the housing, they still have to borrow the funds first to buy the housing that they're going to be renting out afterwards. So a very large part of the cost of housing depends on the interest rates. So if the central bank that controls the interest rate were to lower the interest rate, the cost of housing will tend to fall. At any given point in time, the housing stock is essentially fixed. You cannot change the housing stock very, very rapidly. So when the cost of housing goes down, the demand for housing goes up, prices start to rise, and this is then a signal for people to start constructing more housing, if you like. So when interest rates come down, the demand for housing goes up, house prices go up, and you tend to have more investment in housing. That is something, an effect that I think no one in Ireland can have missed in the last 20 years. There's a second way that this works, which is equally important but not always as obvious. Higher housing prices basically boost the value of collateral. When you borrow to buy a house, the house serves as your collateral. When this collateral, the house, goes up in value, you as a household may feel wealthier. Banks realizes that people that hold housing, private individual or firms, are wealthier. So banks start to feel more secure in their lending, and the total effect of this is to increase bank lending in the economy, and of course with more bank lending you have more demand for housing. Now of course this is trivial, this is all very well known, and I'm not going to at all talk about this first mechanism or first reason why central banks care about the housing markets. The second reason why central banks and financial regulators care about housing markets arises from the fact that property-related lending in the form of mortgages or loans to property developers, or loans to construction firms and so on, are a very large part of banks' lending portfolio. In fact, in Ireland this part was enormous. It was something like 2/3 of banks' loan portfolios were related to the property market before the crisis. Similarly, a mortgage is in many cases the biggest financial liability of a household. The house is their biggest assets. So these are things that really matter for households. And central banks and financial regulators, they want to make sure that banks don't lend in too risky ways. And they want to make sure that banks treat their customers fairly and so on. And this is, of course, an issue that the governor of the central bank, Patrick Honohan, and my colleague Matthew Elderfield, the deputy governor responsible for financial regulation, have given a number of speeches about recently. So I will not discuss this issue today either. Instead, I will focus on the third issue, which is the link between housing booms and financial stability. As we have seen in Ireland, a sharp fall in property prices can trigger a system-wide financial crisis. And in turn, this can lead to a fiscal crisis for the government. And central banks, in their role of macroprudential policymakers, something that I will define as I go along here this afternoon, have good reasons to try to prevent such boom-bust cycles in property markets. And this will be my focus here today, what central banks can do about these property cycles, what the issues are, and so on and so forth. Now, one reason this is a timely topic is that after, or as a consequence of the current financial crisis that hit most of Europe and large parts of the world outside of Europe, there's much more focus among central banks on ways to avoid property bubbles and ways to avoid them impacting on the financial system the way they have done in so many countries. Now, most obviously these days, of course, is Spain, which is written up in the newspapers basically every day. Now, I think as a consequence of the financial crisis, there has been growing realization that it's not enough for financial regulators to worry about the stability of individual financial institutions. This is what we think of as, I want to define some terms here, this is what we think of as microprudential policy. And this is the task of the financial regulator, which in the case of Ireland, as I said, is the central bank. One needs to look at the risks to the overall financial system. And this is what I mean, this is what I think of as, what we think of as macroprudential policy. And these risks are what we describe as, or call a systemic risk. And in the case of Ireland, again, it's the central bank which is responsible for this. In other countries, it tends to be, these responsibilities tend to be spread among a number of different regulators. So this is a little bit like, think of the car analogy. Just because each and every car has gone through a safety inspection, and just because each and every driver has a driver's license, that doesn't mean that we won't have traffic jams or car accidents and so on and so forth. Much of financial regulation before the crisis focused on ensuring the stability of individual firms, individual financial institutions. But too little emphasis was attached to thinking of the overall financial system and the responses of the overall financial system to various shocks and so on and so forth. So this focus on macroprudential policy is in fact rather new. It's being most obviously seen in Europe through the establishment of the European Systemic Risk Board that deals with these issues at the European level. I think, I hope if I'm too quick, you will have to tell me. I'm trying to slow down a little bit. So. Okay, so that's the background, and I think the first thing that I can usefully do here is to look a little bit at the current property bubbles, if you like. And the key point I would like to get across here is that property bubbles are in fact quite similar, both across countries and over time. These they don't happen every year, but when they happen, they look very similar, if you like. These are rare phenomena, but they happen. When they happen, they look pretty much the same way. So to start out here, I have plotted house prices in 10 countries. And on the left-hand side, you can see house prices in Germany, Ireland, the Netherlands, Portugal, and Spain. Now, I want to say as a starter here, it's very difficult to compare internationally house price indices because they are constructed in very different ways. For instance, are you measuring the price of an apartment or a house? Are you looking at prices in the capital city or over the whole country? Are you measuring prices in terms of one unit of housing or 1 square meter of housing? And so on and so forth. So it's very difficult to compare these things. So I would like to emphasize this. But what we see here on the left-hand side is that house prices in Ireland in the last, between 1999 and 2007, rose from an index value of about 100 to about 250 and fell back. They rose about equally much, perhaps even a little bit more, in Spain. In the Netherlands, they rose, that's the red line, they rose less. In Germany, in fact, in this period, house prices fell by about 6%, I think, on this period. So we've seen big divergences across countries. If you look on the right-hand side, you see very large increases in the United Kingdom. You see large increases in Australia and in New Zealand. Interestingly, the US house price boom here looks quite moderate. House prices rose from 100 to 150, so or 170, about 70%. A relatively small boom in international comparison. So in the years before the crisis, we've had a run-up in house prices across the world. Some countries had very, very large increases, like Ireland, like Spain. Other countries saw very small increases, even falls. If you look on the right, on the right-hand side there, you see that in Switzerland, prices also rose very little. Now, these house price increases, they were all associated with very rapid credit growth. And here I have plotted for the same countries increases in credit. And of course, credit can also be measured in different ways, so there are measurement errors here as well. So we see that credit growth and house price growth goes together. And that raises the question, what drives what? And this is by no means self-evident. And there are two possibilities. And if you want to, the difference between them is the role of the banking system, if you like. One story says that greater availability of financing, perhaps because interest rates have come down, makes it possible for households to borrow more, and they borrow more, and in doing so, bid up the price of housing. So in this situation, in this case, what really mattered was changes in the supply side of the financial system. The other possibility is that strong economic growth of the type that Ireland saw in the 1990s as a consequence of the convergence process with Europe fed expectations that growth would continue to be high in the future, that people would be wealthier in the future, and that led them to buy housing now, if you like. And in buying housing, they of course had to ask for credit. And in this situation, the association of house prices and credit comes from the demand side, if you like. In this situation, the banking system at most play a passive or an accommodating role in extending credit. Now, we don't know the relative importance of these two phenomena. I think both aspects will have played a role, but it's very difficult to figure out how much of this is demand-driven and how much of this is supply-driven. Both factors would have played a role. Nevertheless, I think this episode raises two important questions. And the first question is, why was so little done in these countries to rein in this house price boom? House prices were essentially exploding in so many countries. Why didn't anyone do something about it? I think it's important to recognize that house price booms are in fact very popular events for many people. And that's important when we think about ways of stopping them, and I'm going to talk about that later on. Why are they popular? For households, they're great. They bought a house, and it was increasing in value by 15–20% every year for 5 years in a row, or 7 years in a row. So households feel wealthier. This is great. Made a lot of money here. So they have no reason to stop it. For banks, these are very profitable events. In house price booms, banking is very safe because you lend for someone, you lend 100,000 for someone to buy a house. The house is worth 150,000 a year later. If the borrower defaults, you can sell off the house, get the 150,000. The bank takes the 100,000 back and gives the borrower the rest of the money. This is safe lending. So it's very profitable and it's safe lending. So banks have no reason to stop this. And for the politicians, for the governments, of course, house price booms are booms in the economy, and you have very rapid growth in tax collections. So this makes it possible, in fact, to cut other taxes and it makes it possible to finance more government spending, more schools, more bridges, more this, more that. So the house price boom, a fundamental problem is that house price booms are actually events that are very popular. It's very difficult to find someone who says we should stop this thing. It should be the central bank that does this. I'm going to come to that in the end, but it's important for the moment to recognize these are very popular events. The second important question is to ask, what determines the size of the collapse? Why did prices fall back so much in some countries, so much in some countries and less in others? And here it looks like the amount of leverage, the amount of borrowing, irrespectively of what caused it, supply or demand, as the sheer amount of borrowing seems to be the best predictor of the size of the fall. And I have a very simple graph here. There's a lot of formal academic work on this. I was going to give you my little snapshot graph here. So on the left-hand side, on the vertical axis, you see the fall in house prices in these 10 countries between 2008 and 2011. And you can see Ireland is down there with house prices then having fallen around 45%. They're now fallen some more than that. We're probably up to about 55% or so now. And that's on the vertical axis you have the fall in house prices, or the change in house prices, negative in most cases. On the horizontal axis on the left-hand side you have the run-up in prices during the boom. And in the graph on the right-hand side you have the run-up in credit during the boom. And the association here, even in this little simple graph, between the amount at which credit expanded between 1999 and 2007 is more closely correlated with the amount with the fall during the crash. The correlation coefficients here are 52 on the left-hand side and 86 on the right-hand side. But it's much more formal work that underpins this done by the IMF and others. So we do know that credit really matters, because credit seems to determine how much prices fall once they start to fall. Okay. The next, how am I doing with time here? Sorry? Okay, good, great. So the next thing I would like to talk about are the economic consequences of house price booms and house price busts, if you like. Of course, the social consequences of a collapse in house prices is enormous. Here I want to focus on the economic consequences, so we can see a little bit better what happens when we have these booms and when we have these busts. The first thing we know from the historical record, and this is something a number of authors have worked on, is that we know that house price booms are frequently followed by a collapse in house prices. House prices rise very rapidly and then they fall back, exactly as they have done here in Ireland. And furthermore, we know that when house prices fall a lot, we frequently have a financial crisis. So it's a simple rule of thumb. Every second episode in which house prices run up a lot is followed by a crash. And every second house price crash is followed by a financial crisis. So the link between house price booms and financial crisis is very strong in the data. These are events that when they go wrong, if house prices rise very rapidly, and when they go wrong, there's a pretty fair chance prices are going to come crashing down, and it's a pretty fair chance that this will pull down or have a big impact on the financial system. So historically we know that this is the case. This doesn't rely at all on data or on the most recent 5 or 10 years. This is something that we have seen observed over time in a depressingly large number of countries, I must say. And the second thing here is that we know, there's an IMF paper by Crow and co-authors, is the role of leverage. If you borrow, the more you borrow effectively, the larger is the crash. And it's easy to see why. If households borrow a lot, when house prices start to fall and you start to see defaults by borrowers, this will have a very big impact on banks' capital positions. And banks then will tend to cut back on lending as they realize that lending is in fact much riskier than they thought. And when bank lending starts to slow after the crisis or even contracting, this will make it more difficult for the economy to return to growth. So it's easy to see that the more exposed banks are, the more hit banks are, if you like, by the crisis, the greater will be the overall macroeconomic effect. So we care about house price booms because they very frequently lead to house price busts, and they tend to lead to financial crisis. In a sense, the Irish experience here is actually not at all unique. There are quite a few countries, including my native Sweden, much of Scandinavia had house price crisis in the late 1980s, early 1990s. Also many countries have had them in the past. These are phenomena which come back many times. What are the consequences of this? This is an IMF study by Claassen and co-authors, and they look at the evolution of a set of macroeconomic variables around house price collapses. And they look at quarterly data for some 21 economies in the period between 1960 and 2007. They have a very simple strategy here. They plot these variables relative to the peak of the housing cycle, which is set as a quarter zero, and then they just see how these things evolve before and after. And this little red line here indicates the upper and lower quartiles of the distribution, if you like. So it's a measure of how much dispersion there are across countries. So what we see, of course, trivially, is that house prices come crashing down. When they turn and start, they come crashing down. And they tend to contract for quite some period of time. Here, during all these, in these 3 years periods after the crash, they were falling on average for these countries. Equity prices seems to be quite relatively unaffected effect by house price booms. There's not too much action there. The second thing we see is that real GDP, real economic activity, or output, if you like, also collapses following a house price, when house prices start to fall. And here you see on average output growth fell to zero. Of course, in Ireland, output has fallen in an absolute scale by quite a large amount. We also see that household consumption falls across these countries. Not surprisingly, we see that residential investment turns negative. That is, people don't invest and the housing stocks get eaten up by depreciation. And we see that non-residential investment on the right-hand side there falls to zero, effectively. We see that unemployment rates pick up. Of course, in Ireland, the impact on unemployment has been dramatic, but unemployment has risen from something like 4% before the crisis to about 14% now. That, of course, it's a huge illustration of the highly adverse social consequences of house price busts. We see that credit growth in the economy slows, and as you probably know, in Ireland, credit has actually been contracting for some period now after the boom, after the bust. So we know the macroeconomic consequences of these house price busts are enormous. Very, very big impact on growth, on unemployment, on consumption, on investment, and so on. What do we know about the recovery? That's probably the most interesting question for us here. If you look at house prices, how quickly do they recover? Well, and this is an example of a case of five noted or frequently studied house price busts in Japan, Finland, Norway, Korea, and Sweden, and also Ireland in here. You see, in some cases, it took as much as 10 years. It took 10 years before house prices were back to the level they started out from. In some other cases, it took 20 years. In other countries, they haven't even, after 20 years, they have not even recovered to the level they had. There was a very massive house price bust in Norway in the early, in like 1910, I think. And it took 70 years or something before house prices came back. So these falls in house prices, it frequently takes a very, very long time for prices to recover to the level they had before. Here we have plotted the data for Ireland. There's a green line there on the left. You see that it had fallen there by by 60%, by 40%, so this is still a little bit old data. What happens to GDP? Well, GDP tends to recover faster than so, but it can take quite some time. Of course, in the case of Ireland, here on this graph we have used forecasts of GDP from the central bank until 2013, and you see here GDP has fallen by something like 10%, and that's 6 years after the crisis from 2007 to 2013. So you see the time it takes for GDP to recover also varies a lot, but it can take many years. So these house price booms have long-lasting effects. When they turn into a crash, can have very long-lasting effects on prices. It can have very long-lasting effects also on economic growth. So the macroeconomic consequences of house price booms that turn into busts are severe. A second reason we worry about these things is that a financial crisis, if they're triggered by a house price bust, can very easily spread to a sovereign debt crisis, a fiscal crisis, if you like, for the government, which has also happened here in Ireland. And there are three ways in which this comes about. There are three mechanisms here, and I will show you some graphs here in a second. The first is that the crash in house prices tends to be associated with much weaker economic growth or even economic contraction. And that has a direct impact on the government's tax collections. So with lower economic growth, you have less tax collections, and that tends to move the government's fiscal position into a deficit. Unfortunately, that effect was particularly pronounced in Ireland because in the boom period, taxes were shifted from relatively stable sources of taxes, such as income taxes, to cyclically much more sensitive taxes. And I will show you that in the next graph. The second mechanism, which in terms just of numbers is less important, is that when you have a large recession, unemployment rates, of course, picks up, and social spending, unemployment benefit spending, and so on and so forth tends to pick up as well. So that effect also tends to worsen the government's fiscal position. Numerically, that effect is much smaller than the first effect. And if you do have a banking crisis, which not will, I think, like a quarter of all, as I said earlier, but a quarter of all house price boom may lead to a banking crisis. You can have a very large need for capital injection into the banking system by the government, and that could lead to a very large run-up in public debt. And that I will show you that in a while as well. For Ireland, obviously, that's a very major driver of the government's fiscal position in Ireland. So if you look on the left-hand side here, you can see the importance of cyclically sensitive taxes in Ireland. They rose from something like 7% of total tax revenue to about 16% of total tax revenue between 2002 and 2006. So this is our capital gains taxes. These are value-added taxes from the housing sector, stamp duties on property and land. So, of course, when the housing boom turned into a housing bust, these things just evaporated. These things went from 16% of tax revenue to something like 2%. They just disappeared, if you like. Of course, this is a very major problem. They have just collapse in such a large part of government's. Sorry, here. Sorry, in the government's revenue. Sorry. So yeah, you see it there. If you look at the right-hand side here, you see unemployment rates for a number of countries, and they have all picked up. And with that, the need for spending on unemployment benefits, social welfare, and so on and so forth. So that is a second reason why then the government fiscal position tends to worsen. Overall, in Ireland, there was a very large deficit that developed. In 2009, the public deficit as a fraction of GDP was 30%. This also entails the funds used to shore up the banking system. If you disregard that part, it was still massive at something like 11% of GDP. My native Sweden had deficits of around 11%, 10, 12% of GDP in the early 1990s. So this can easily happen if you have a housing bubble that goes the wrong way. Interesting, what you will see in the years before the crisis, Ireland had very stable government finances and large public surpluses, if you like. On the right-hand side here, you see the stock of public debt as a fraction of GDP, and that fell to about 25% before the crisis. The government's finances were extremely healthy before the crisis. But once the crisis struck, the stock of debt to GDP rose here to over 100%. The little white part in those pillars is the part that comes from the government's capital injections into the banking system that added very materially to the stock of public debt. So, fiscal crisis, or sorry, financial crisis, typically have a very big impact on the government's finances, either through the tax collections or if there's a need for the government to shore up the banking system. That then leads me to the question of macroprudential policy, or what can we do? What can policy be to avoid these situations? This is very much sort of a new area, this whole idea of gearing policy not to individual banks, but to the overall financial system. So I said that central banks worry about housing markets because booms can lead to very sad outcomes. Now, what can we do to reduce the likelihood of these housing booms? Well, among policymakers, there is a need to focus much more on the system, on the financial system as a whole. Instead of just saying this bank is okay, that bank is okay, we should say, is there some dynamics in the financial system that's going on that it may be good for each and every bank, but for the system as a whole, something is going astray. So we need to focus on the system as a whole. We also need to reduce the potential bias in favor of inaction among policymakers that comes from the fact that these booms are in fact popular events. In some way, we need to make policymakers more willing to stop the boom when it takes off than they were in the past. We need someone, if you like, who can pull the plug on this thing. Now, I think the first thing you need to be able to do this effectively is that you need to have a clear legal mandate for someone to do this. You need to tell someone that you are responsible for the overall financial system. The problem in many countries before the crisis, and I'm not talking about Ireland here as a general observation on the global economy, was that responsibility was never clearly delineated. Many central banks said that our focus is to deliver on an inflation objective set to us in the Central Bank Act. The Central Bank Act doesn't tell us to do something about housing prices and so on. So you need to have clear responsibility assigned to someone, some policymakers must have a clear objective. Without a clear objective, without someone being responsible, it's very difficult to find someone taking any action. Many policymakers, central banks, after the crisis, in many countries, have tended to say things along the lines, well, we knew it was dangerous, but it was not our responsibility. It is nowhere mentioned in our Central Bank Act that it's our task to stop this. So we need to assign clear responsibility. The second thing which is needed is operational independence. There's a lot of evidence in the literature that central banks that are free to act as they like are likely to do a better job than central banks that are under political influence. And the reason for that is that many house price booms are actually popular events. And if it was up, if central banks want to take action, it can be very difficult to build political support for this. No one is going to like you if you start tightening up in a boom, because booms are, as I've said here already, quite popular events. So you need to have independence. You need to have someone that can act and say, well, look, it's my responsibility to act. By law, I have this objective, ensuring the stability of the overall financial system. I now believe that we have unsustainable dynamics in the financial system, and I'm going to do something about it. I have the legal right to change whatever regulation is necessary to do something about this. This is a weakness, I think, in the financial architecture in many countries. Many countries, I'm not talking about Ireland here, in many countries before the crisis. This is a recurrent phenomenon Housing booms happen and have happened so many times. So I think we need to focus here on the stability of the overall financial system, not on just individual institutions. And we need to have some tools that we can use to rein in the financial system, if you like. Now, I want to say here, when we discuss these tools, there are many policy tools that does have an impact on house prices, but they are not best, we shouldn't think of them as macroprudential tools. For instance, monetary policy will have an impact. Lower interest rates will make it easier to finance a mortgage and will make people borrow more. Monetary policy should probably be directed towards controlling inflation. And it would be a mistake, at least to my mind, to use that to rein in asset price bubbles. Microprudential tools will have some impact here, but they are geared to enhancing the stability of individual financial institutions. Tax policy will, of course, also have an impact on housing prices. But again, tax policy are being set for other reasons. So macroprudential tools, I think, have two qualities, if you like. First of all, they explicitly target the build-up of risk across the financial system. And secondly, they are under the control of the macroprudential authority. This is the view or the definition of macroprudential tools that the IMF has been working with and that has picked up additional sort of growing support in the international central banking and regulatory community. Now, what could these tools be? What could we do to rein in these house price bubbles? Well, we could require banks, if you like, to hold more capital against certain types of lending. So if we tell banks that this type of lending is quite risky, so you need to hold more capital if you want to lend in this format, then banks will have a financial objective to not do that. They will say this type of lending costs us more, it's not so profitable for us anymore, so we will lend less. You can tell banks to put away provisions against possible future losses in the good years. This is something that paradoxically was used by the Bank of Spain. I think this is probably one reason why the consequences the Spanish housing bubble, or there's a tendency to dampen the consequences of on the Spanish housing bubbles. In the good years, banks were required to put away greater provisions against the possibility that house prices would actually turn and they would sustain losses. You can use loan-to-income ratios here, which basically says that there are restrictions on how much banks can lend relative to the incomes of the borrowers. As you know, in some countries, you could get a loan without even indicating any income to the bank. I mean, this strikes you as astonishing and not good banking practice. In fact, that judgment is right, I think. So what this does then is that it helps ensure the creditworthiness of the borrower. You can't borrow too much. The next thing you can do is that you can introduce time-varying loan-to-value limits. It tells you something about how much the bank can lend towards a house that you want to buy. These were used very effectively in Hong Kong. Hong Kong suffered a very severe housing crisis, price fall. Prices fell by 70%, not 70% around the time of the Asian financial crisis. Despite that, there were no banks in Hong Kong that went under. Banks remained profitable despite this draconian fall in prices. And one reason for that was that banks there had been this loan-to-value limit of 70%, 60% for luxury properties. So banks couldn't lend so much. So if you have a loan-to-value ratio, then that will sort of shore up the value of collateral. Let's look at these loan-to-value ratios here, actual in Ireland during the boom years. And what you can see, the fraction of loans that had a loan-to-value ratio less than 80% fell from something like 75% in 2000 to something like 55% in 2006. That's the fall in those pillars on the left-hand side. And if you look at the fraction of loans that had a loan-to-value ratio of 80% or more, the bank lent more than 80% of the purchase amount. That fraction rose from 25% to something like 45% during the boom. Now this means that during the housing boom, credit picked up for two reasons. First, house prices rose, so banks were willing to lend more. But banks were also willing to lend a greater fraction of the house, or the value of the house. And this is, of course, precisely the opposite from what you really would like to see. You would like to see banks becoming more cautious in a boom. You would like to see the loan-to-value ratio to be falling during the boom. And one can imagine, so these loan-to-value ratios, they would have two effects. They will tend to increase bank resilience because they would prevent banks from lending too much in the boom. So if prices come down, the banks will not be hit as much if the borrower defaults. But they will also reduce credit demand because they will require the buyers of these houses to come up with more cash themselves. And if they are unable to do so, you would reduce the amount of housing being purchased, if you like. So it will function that way. I don't know if loan-to-income ratios and loan-to-value ratios are feasible in Ireland, but I think these are the types of tools that one need to reflect on and see could they play a useful role in guarding against the repetition of the current crisis. Overall, with the exception of a few Asian countries, in particular economies, I should say, Hong Kong and Korea, there is little experience with these macroprudential tools, but there is some scattered evidence that these can be helpful. It looks like they have tended to slow property price increases, tended to reduce transactions volumes, and they tended to reduce property lending and non-performing loans, at least in the few countries that have used them. Now, it's important to understand that one of the benefits of macroprudential tools is one can focus them on precisely the type of lending that you think is most risky. Some observers suggest that instead of using macroprudential tools, we should just use monetary policy. Just raise the overall level of interest rates in the economy and use that to prevent or to guard against asset price bubbles. But I don't think that's a very good idea. Monetary policy is a very blunt tool that it impacts on all borrowers, risky or not risky borrowers. And they will have broad effect on the overall economy. In particular, if you tighten monetary policy, you will drive inflation down. And if the inflation is at the right level in the beginning, you could drive inflation down to zero, or you could even generate deflation if you use this to stabilize the economy. And you are most likely to have an increase in things like unemployment and so on if you use these tools. They're simply too broad tools to use for this purpose, or should not be used as the first measure. So macroprudential tools are better because you can actually sort of streamline them. They only impact on some types of lending to some borrowers, perhaps in some geographical areas, and so on and so forth. In principle, you can make them more narrowly focused. But they also have shortcomings. In particular, they provide strong incentives for circumvention. I think in Korea, there was controls on the amount of lending for property purchases that were up to 3 years. So suddenly, housing loans tended to be for 3 years and a day. So the regulations didn't apply. There's also a risk of regulatory arbitrage. Basically, if you put restrictions on the banking system, this may move over to the shadow banking system. Or people may borrow abroad, or borrow in foreign currency, and so on and so forth. So these are problems. There are also going to be interactions between these macroprudential tools and other policies. And since we have so little experience using these things, it's hard to know in the beginning how well this might work. And again, whenever you use these preventative tools, you're going to have this sort of burden of proof problem. So you, as the policymaker, you say, I will now take a measure here to slow the property bubble. And people say, well, what's the problem? There's no problem. The economy is growing fast. Prices are going up. The banks are healthy. Banks are profitable. They're healthy, right? You're going to slow the economy now? I mean, why are you doing this? It's very, very difficult to motivate why you would like to take these measures in an economy that really looks very healthy. You know, the property price boom is the tide that raises all the boats. The economy looks great in the boom, and you're going to stop the party. Very, very difficult. Very, very